Good afternoon, everyone. Robert Rayburn here at Life Pro Asset Management. I hope that everyone's having a fantastic Monday so far. Now, we are recording this a little bit back in time on July 3rd. So I do want to make sure that we wish everyone a happy Independence Day, a happy July 4th holiday. And I hope that everyone had a happy, safe, and fun holiday weekend. We have so much to be thankful and grateful for, living in the best country in history, and certainly could not be more thankful and grateful myself. But with no further ado, let's go ahead and get started. So the title of this week's presentation is it time to invest overseas? And the real reason we're asking this question is, when we look at 13, 14-year performance, the US market has been the leader across the planet, and technology has been the key driver of that. But we have reached levels now where overvaluation has certainly become a rule of thumb for technology stocks within the US market. We look at the average US stock outside of those 6 or 7 largest stocks. Those stocks have started to struggle so far this year. Now, we're not talking about a sell-off, but we're also talking about a broad stalling out. And I think a lot of this goes back to just the over allocation we're seeing in mutual funds, institutional investors in US markets relative to overseas. Meanwhile, overseas, you're having a lot of great companies that are trading at levels where the valuations are very attractive, growth rates are attractive, and at some point we reach a tipping point where an institutional investor says, hey, you know what? There's a lot of pent-up value here, and there's some key catalysts around the horizon that could unlock this value. And that's what we think is setting up here. We saw in China and emerging markets a big rally in March and April and the first half of May. And then we saw a pretty decent pullback in the back end of May and then throughout June. We saw that with our own performance, right? So when we look at what's happening right now, we see a bear to bull transition. Usually you get a big major upward thrust for that first rally. You get a retracement of that rally. And then as you get into support, you would expect that reacceleration. That's exactly what we talked about last week. Hey, you know what? A lot of these markets in China and emerging markets are hitting support levels. And we would expect now is about the time where they would reaccelerate. We had that this week. So next week, we want to see follow through. So that's what we're going to talk about this week. 3 big things: China and copper, both bouncing off support. That is really key. If it was China by itself or copper by itself, we would say, you know what, we need more evidence. China and copper moving together both into support off of that initial rally and now reaccelerating off of support together, I think paints a very interesting picture. And we'll talk about what that means. Number 2, US consumer continuing to show signs of pulling back. And we see that in the economic surprise index and various economic reports. We'll go through again, of course, what that means for your money. And then the last thing, credit markets remain fairly supportive for equities. We're not seeing any contagion as it relates to slower growth or widening a non-performing loan issues representing themselves in the bond or credit market. So that's a good thing. But again, we'll show the chart on that. So when we look at China here, this is the Shanghai index. Sorry, pardon me. This is the Hong Kong index. So it's the main representation of Chinese and Hong Kong stocks in the mainland. And so when we look here, we had a big significant rally off of this generational bottom, what we believe is a generational bottom for Chinese and emerging markets, and Hong Kong stocks. Big rally. This was that big move. I'm sure you noticed it in your accounts. This was that big move that we saw in the month of April and May, and then the sell-off, right? So the sell-off is a pullback. Stocks don't go up together in one line with no pauses or pullbacks. We believe that this was the bottom. This was your major upward thrust. This is your pullback into a breakout. When we look at these prior resistance points, and this is about when we would expect things to turn back higher for the next leg higher, right? So stage 2 of that bull to bear, pardon me, that bear to bull transition. So broke out, pulled back to breakout point, and then that resumption higher. And actually, one more thing I do want to point out is that it's not just China. So when we look at the PE for the S&P 500 right now, just around 20 times. That's fairly expensive from a historic standpoint. When we look at MSCI Europe, European stocks are only trading at 12.8 times earnings. When we look at MSCI Japan, which has had a significant rally, still only at 14 times earnings. We look at most Chinese stocks that we're focused on right now, anywhere from 8 to 12 times earnings. So these stocks are cheap. The growth rates are attractive, and you're starting to get the technicals and the trading conditions to play ball. So that's what we really like right now. But we want more evidence. So let's look at China tech, right? So within China, what's that tech index looking like? So we look at Chinese tech stocks, again, same playbook pattern, generational bottom, assuming we're correct on that, re-acceleration here in April and May, big pullback throughout the back half of May and into June. And then right as we hit support, boom, 2 high volume breakout days to the upside, Roth's support. Now, the next step is we want to see follow through. Are there any indicators that may lead more evidence to say that, hey, this actually is a re-acceleration, the second inning of that bear to bull transition for the China market? Well, we're going to go through that. But before we do that, real quick here, we do believe that China tech in particular, with some of the cheapest valuations and most attractive growth rates within the EM bucket, is where US tech was in 2022. So when you think of where NVIDIA and Facebook were and Google and those types of companies, not the small caps, but the large mega caps, the China large mega cap tech stocks, such as Alibaba, as JD, or Meituan, these are stocks that we know are large mega caps that represent a broad cross section of the Chinese and EM economy. We believe that they have reached those valuation levels and upside levels that US tech represented in 2022. So what we view as low balance sheet risk ways of gaining significant upside in the future. But that other big indicator is copper, right? So when we think of Dr. Copper, it's called Dr. Copper because it tends to be a leading indicator for the global economy. But in addition to that, the majority of global copper demand comes from China. We've talked about that many weeks. So when you want to get a good sense of what's happening or not happening in China, look at copper. Notice what happened here with copper. Bottom placed here, and then huge reacceleration in April and May. Where did we hear about that before? Oh, right. In China tech and China stocks in general. Reacceleration, April and May. Notice where China tech topped out at. Notice where copper topped out at. Mid-May. Sell-off right into 100-day moving average support. And then reacceleration. Remember we talked about this last week, is that China had not yet started the bounce, but copper had started the bounce. And we had said, hey, very interesting that copper is starting to bounce. Let's see if China happens next. And certainly it did. So I think the fact that these two are coming together paints a very interesting picture of what could be wave 2 of that bear to bull transition. We go back here stateside. One of the things that we've been paying a lot of attention to is this broad weakening, not just in the economy, but the US consumer. So we look at the US consumer on the surface in terms of consumer stocks, things look pretty good. Positive trend, positive RS or relative strength, and positive price action. But when we look at it on an equal weight basis, so in other words, you know, the two big stocks that dominate the consumer discretionary, Tesla and Amazon, they mask a lot of the weakness for the average stock there, right? So we look at the consumer discretionary index relative to the S&P 500 on an equal weight basis. So in other words, we are normalizing the impact of Tesla and Amazon on the index, we notice here is that consumer discretionary stocks have flipped negative in terms of relative trend. So we want to be careful there and ask ourselves the question, why are many of these consumer stocks in the US starting to break down? Is it a weaker economy? Is it a pushback on pricing? Or is it operational execution with many of these companies? If it's one or two companies, you can kind of point to execution usually. When it's a broad cross section of companies, it's very hard to say that all these companies are screwing up. It's usually something bigger. It's usually something more broad. So we suspect it's probably one of these first two, a weaker economy, a pushback on pricing, or a combination of the two. So let's take a peek and figure out what is happening here. Now, remember, if it's a pushback on pricing, that's great for a company like Walmart or Amazon, right? Because they compete on prices. They are so large, they have so much scale that they have pricing power with their suppliers, can push through lower prices and still make margin. So very, very key there. So when we look at the economy, right, tackling that first question, is it a weaker economy? What we have noticed and continue to notice is that the economic reports are surprising to the downside, right? And what that means is that on Wall Street, there's always a forecast, right? So saying, okay, I think US jobs are going to grow 200,000 in the month of May. If the jobs report comes in at 175,000, that is a negative surprise. Yes, there was still job growth, but it was slower than expected. So when you look at this economic surprise index, it is an aggregation of all the economic reports, and are they surprising to the downside or are they surprising to the upside? When you surprise to the downside, the red line goes down. And what you can see here is that things have been broadly surprising to the downside. And it doesn't really necessarily mean a whole lot for stocks per se. You wouldn't want to make a stock market call based on that because we actually want a slower economy as it relates to stock market and lower rates. But what does it mean for the bond market? You see here, historically, the bond market has kind of followed suit with the economic surprise index. So in the past, that slower economy has led to rates coming down. It has allowed rates to start to trend lower. So that's really key. So if the economy is starting to weaken, should we start to take action and lock in some of those higher interest rates that are available to us today? That's the key question that we ask a lot of our clients on the bond side, right? So for those conservative investors that are looking to generate low risk income, is now the time to start locking in some of those attractive rates before they start going down? Because once you lock it in, you can still earn that interest even though rates go down. So I would encourage investors that are listening to this video to consider the question, right? It doesn't necessarily mean you need to, certainly doesn't mean that you have to, but it's something to consider. The second question, of course, is, are companies missing because of price? And what we've noticed is that for many major companies, so Starbucks, McDonald's, Nike was down 21% in one day last week. Starbucks got destroyed, down 18% in one day. These are major companies. These are not rinky-dink small cap companies. These are major blue chip brands that are getting destroyed on, you got it. They're getting destroyed on price. For the first time, we're seeing US consumers, and we're hearing it from management teams on these calls, they are pushing back on price. They're saying enough is enough. I'm not paying $8 for a latte. I'm not paying $20 for a Big Mac and fries. That's ridiculous. I'm not paying $200 for a pair of sneakers. And again, it doesn't take a genius to figure out why they're pushing back, because not only has inflation been ridiculous the last couple of years, but as you can see here with these inflation lines, it hasn't kept wages are also going up, but not as much as price. So the blue line is your what we call the common man inflation, right? So we specifically focus on food, energy, shelter, clothing, utilities, and insurance, our big expenses for the average middle class American. The red line are wages. So you can see here, wages broadly keeping up with everything, and then look what happens. That blue line really starts to pull ahead. So in other words, Americans are feeling poor. Why? Because they're technically making less from purchasing power perspective than they were just a few years ago. You're seeing it in the presidential polls. You're seeing it in earnings reports across consumer companies. And you're just seeing it in the broad malaise of the average US consumer in those consumer confidence surveys that we get every month. Now, all of that said, this doesn't necessarily mean it's bad for the stock market, because what this also allows the Federal Reserve to do is if prices are starting to be cut because these companies need to respond and keep their customers, and you're getting disinflation starting to pull back closer to 2%, then rates start to go down and you start to get support for stocks because lower rates are good for risk, right? So we broadly believe when we look at the data right now, we're going to get some labor market information on Friday, and this recording is being done ahead of Friday. We think U.S. job growth is going to slow, but it's certainly we certainly don't think, and that's not a guarantee, that we don't think that that job growth is going to be negative by any stretch of the imagination. We just think the labor market's cooling. So in other words, we think the U.S. economy is softening, but it's not contracting. And we see that in the bond market. Again, no red flags out of the bond market. Broadly, bonds and credit remain supportive of equities or stocks. And if we saw signs of stress in the economy building up, you would likely see it here first in the bond market where these spreads would start to widen out. In other words, the cost of accessing credit for a private enterprise in the US would start to go up. This line would turn higher. Unlike stock prices, we don't want this line to go up. So, right now, I think that paints a broadly supportive picture for risk. So key takeaways here on July 4th week is that China and the EM are bouncing off those key support levels. We do think that slowing US growth may lead to lower interest rates in the back half of this year. So 3 key takeaways there. US stock market leadership remains very, very narrow. Let's pick our spots. Let's not try to be too cute. Number 2, China copper actions suggesting reacceleration because they're happening in tandem with each other. Number 3, and lastly, but certainly not least, credit remains supportive of stocks. That's what we got for you this week, 888-543-3776. Please feel free to reach out to your advisor. Again, happy July 4th to everyone. We live on the best country in the history of humanity, and we could not be more grateful and thankful. And we cannot be more grateful or thankful for our clients' business. So please feel free to call with any questions. Thank you again, and have a fantastic week.